Vivek Mavani as well as Naresh Mehrani joining in. And Vivek, let's get a sense as to how, you're looking at Reliance Industries. Yet another check coming in for Reliance Retail this time around after seeing a fairly subdued couple of trading sessions where the stock was hammered pretty badly out of shape. It's back above that 2000 mark. What's your outlook when it comes to the fundamentals of RIL?
Well, as far as the fundamentals are concerned, I think this value unlocking story both on the geo business as well as retail will continue. As regards the bringing in the strategic partner Aramco for the oil and gas petrochemicals business, that seems to be put on shelf. So maybe after a sharp rally, yeah. Hello. That we have seen in the last few months from sub-1,000 levels to almost 2,300. Some amount of profit booking was to come at some point of time. Short term, maybe to stay in a range of maybe about, say, 1,900 on the downside, 2,400 on the upside. But medium to long term, Reliance remains continues to be a top holding and a top pick for most of us.
From the auto names, Vivek, we've had some great commentary coming in, whether it be from an Aisha, even in terms of numbers that have come in from some of the tractor makers. Anyone really that's looking at the rural market, where do you currently stand on the auto recovery?
Well, as far as the auto recovery is concerned, it is for real. I mean, we have had the first among them, Maruti and Hero, giving out a very positive commentary a few days ago, I think about 2 weeks ago. And of course, the numbers are there as an endorsement. I think that auto recovery will continue. I mean, the rural markets continue to remain strong, but I think even urban markets will now catch up. However, auto companies have already had a sharp run. What has lagged is the auto ancillaries. And if you look at the ancillary space, a whole lot of them have been giving good results. And one of the sectors within the ancillaries which stands out is the tires. So if you look at the numbers for JK Tires, Fiat, Apollo, very impressive numbers. I mean, so there's a genuine cyclical upturn as far as tires is concerned, backed by benign raw material prices and some bit of pricing power coming back, replacement market driving sales, while even auto OEMs have also started clocking high single-digit, double-digit growth rates. So there, JK Tires remains my top pick. I mean, what we saw in the latest quarter numbers, EBITDA at about 355 crores was like highest quarterly EBITDA in 5 years. Margins of a multi-year high at almost 16% EBITDA margins. They have, in spite of the lockdown, so although the first quarter was a washout, in 6 months they have repaid 600 crores of debt as well, which signifies very strong cash flows. And the management is committed to deleverage and further repay another maybe 1,200 crores of debt over the next 3 to 4 quarters. From a valuation perspective, at about 71, 72 that the stock price is going at, it's ridiculously cheap. I mean, when one considers a market cap of about 1,600 crores versus 6 months cash flow alone was like upwards of 900 crores. So rarely do you have a company which has been so beaten down, it trades at like one-time annual cash flow, as if the company was going out of business anytime soon. But that's not the case. So there's a strong, so tires in sector in general have been doing well. JK Tires is my preferred pick simply because of a ridiculously low valuation relative to cash flow.
Vivek, within banks, where's your preference? And would you stick by with the top 5, or would you want to go bottom up?
To the large banks, whether it is, and largely in the private bank space. So the preferred picks continue to be the Kotak Bank, HDFC, and ICICI. The three large private banks is good enough for me. If I had to name a fourth one, then obviously one doesn't need to look beyond an SBI in a PSU space. So I think 4 banks in a portfolio is good enough from a weightage point of view.
But what about the entire home improvement theme, Vivek? Because you saw everything from cement to tiles to sanitary ware, paints. In any case, has been a very strong segment. Again, jump back. Does that investment still hold through, or do you think right now the beta is in favor of the banks?
Right now, the beta is certainly in favor of banks, auto ancillaries, and a lot of the tier 2 sectors or tier 2 stocks, because your tier 1 stocks have already had a very sharp rally. Tier 2 is where the stock price action has lagged the performance. And now that we are having, now that we are seeing very good performances, excellent and the positive outlooks being given out by management, it's time for beta in tier 2. As far as the home improvement space is concerned, I mean, your paints, ceramic tiles, your wood and plywood companies and all that, they have had, I would say, consistent rallies over the last 5 years or so. I mean, playing on the consumer spending theme. So in there, most of the companies seem, I would say, fairly priced. I mean, of course, the growth story continues. There's no denying on that. But there is no cyclicality to growth where you have earnings galloping. So now is certainly the time to place cyclicals where earnings are going to be galloping. Consistent growth stories, long-term compounders have had their day. I don't say it's going to anyway go out of fashion, but probably those long-term compounders will sort of take a backseat from the market action point of view. Certainly the quick beta is to be made in tier 2 mid-cap companies across sectors.
Just winding down to close now, let's take a look at the major gainers.